Welcome back to the channel. It's me, Adam. You're watching Unlimited Options Investing. What a week in the market. Super volatile. The beginning of the week started off pretty green for the first 3 days. Thursday was a bit red, but nonetheless on Friday, Apple, Microsoft leading the way, and we're seeing some pretty good things in the market. Not to mention crypto has been also pretty volatile. It got rocked earlier in the week, and right now we're seeing if we find buying pressure at these levels and if we see a recovery or if we're going to have continued downside. So in this video, I want to talk about the gold metals, the best in-class stock, and how to build your portfolio around the greatest companies in the world, making sure you position yourself accordingly and set yourself up for the upcoming decades. Because whether you like it or not, the long term is eventually going to happen. Things are going to play out. We're going to go through a lot of crap in between that, a lot of fear, a lot of great times, and everything in between. However, eventually, 2030 is going to hit, 2040 is going to hit, and you're going to have wished that you invested back in 2021, because ask anyone out there, they wish they got into the markets a year ago, 5 years ago, 10 years ago. And beating a dead horse again and again and again, you have to risk adjust properly. You have to have that mentality. If things drop 10, 20, 30, 40, 60, 70%, can you stomach that? Can you hold on for dear life? Will you buy? Will you sell? Know what you're going to do before these things happen. Put every scenario in your head, the good, the bad, and everything in between, and know how you will react. Will you have an emotional reaction, or are you going to stay the course as you always planned? Things change pretty quickly, so without further ado, we're going to get to the video. If this is your first time stumbling onto the channel, welcome aboard. Hit that subscribe button here at Unlimited Options Investing. We talk everything from stocks, crypto, options, ETFs. We're investing for the long term. As always, smash that like button. Let's get started. All right. The biggest company in the world, Apple, we all know it. We know the brand, was up huge on Friday, making another all-time high, up 2.8%, now at $179 per share. It's rocking a $2.94 trillion. And the reason I'm showing you Apple is because all the big retirement funds, and we can see that clearly again with that market cap, is in these gold medal, high margin, high profitable, amazing companies that continue growing and providing ridiculous value to our everyday lives. The second stock, of course, Microsoft, was also up huge on Friday, up 2.83%. Not quite at that all-time high. We did reach 349 maybe a few weeks ago. Right now trading at $342 per share, a market cap of $2.57 trillion. Again, another very high margin business. It is a software company which tends to have higher margins, very profitable. They have their toes dipped in anything computing, enterprise software, gaming, and they're just getting even larger. Same thing can be said with Google stock or Alphabet. I just call it Google just because no one calls it Alphabet. Almost at a $2 trillion valuation. Once it reaches about 3,000 and when it hits that $2 trillion mark, more or less. And same idea when it comes to the advertising space, nothing beats Google stock or Meta platforms, which also rocks a $917 billion market cap. And of course, we have Amazon, 1.75 trillion, Tesla, 1.02 trillion, and NVDA, $754 billion. These are the best companies in the world, la crème de la crème. They are changing how we live every day. Now, one could argue a lot of growth has been baked into these companies. They trade at premiums for a reason. They are growth companies as well as defensive in a way because they're not going anywhere. What is their true value? What is the actual intrinsic value? That could be up for debate, but what's not up for debate is that they are going to be the future in the upcoming years. So whether you get into NVIDIA now at 300 or Tesla at 1,000, and they both drop 20% over the upcoming year, that's just short-term volatility. They're most likely going to be much higher. And I'm going to draw it out. What's the difference between a stock that does this from point 0 to year 10? And what's the difference between this? Again, point 0, year 10, and let's say this part in the middle is year 5. They both end up in the same spot, but what happened in between over here was there was a little bit of market volatility that it would have got you going crazy, but again, same end result. Playing in the stock market is a big psychological game. So when it comes to creating a portfolio for yourself in 2021, into 2022, and into the future, So I'm going to show you if I was a growth investor, which I am, and a value investor, how I would build my portfolio in either scenario. And for all intents and purposes, I'm going to show you just American companies. I'm not going to be diversifying internationally just for this video. So the first one I'm going to be taking a look at is VUG. This is my favorite growth ETF long term. It has a 0.04% management expense ratio, so you're paying $4 every $10,000 invested. And this ETF is made up of Microsoft, again, Apple, Amazon, Tesla, Google, Facebook, Meta Platform, NVDA. And then you have a little bit more defensive names in Home Depot, Visa, that aren't quite big tech, and Walt Disney, MasterCard, PayPal. And this is similar to how I have my portfolio set up right now. These big tech names, they are the anchors of my current portfolio. They make up more or less, let's say 70% of my portfolio, with 30% in either cash for a rainy day, or in secondary silver metal names, think AMD, again, Walt Disney, PayPal. I want to add Nike, I want to add Costco, sometimes Starbucks if it fits my portfolio. And what I found very powerful with my portfolio as well is adding options, specifically LEAPs, which are long-term dated options that expire about maybe a year at least in the future. You can really build your portfolio however which way you like, but the main idea is to set yourself up anchored around high-quality gold medal names. Thank yourself in the next 3 or 5 or 10 or however many years that you set yourself up investing in high quality. And if you want 10%, 20%, you can allocate whichever way you want to more speculative, higher risk names. But it really doesn't take that much money in order for those names, if they do succeed and you are right, you do hit that home run. If it goes up 1,000% or 2,000% or whatever it ends up doing, sometimes you don't need that much money, because the main reason why people blow up their accounts is because they scale in too fast, too hard into names. They take on way too much risk that they're not willing to see evaporate if they end up being wrong, and there's a high chance that they may be wrong, especially when you're playing the high risk, high reward game. And to reiterate, that's why I like using options with these kind of names, because they're so much more predictable. Again, they're blue chip companies. The main drawback is the options are more expensive. They are more expensive companies. But there are so many which way strategies when it comes to options. And again, just figure out what works for you. It's so lucrative. And again, the options are unlimited. So secondly, if I was a value investor and I would get more and more conservative the older I am, this ETF MGC, which is the Vanguard Mega Cap ETF, again, one of my other favorite ETFs, it also has a 0.04% MER. Again, $4 every $10,000 invested, and I would set up my portfolio very similar to this one. Again, you have your anchors in Microsoft, Apple, Amazon, Tesla, Google, Meta Platforms, NVIDIA. But then you also have names like JP Morgan Chase, Berkshire, United Health Group, J&J, Home Depot again. More resilient defensive names. Again, they're not going anywhere, but also aren't so susceptible to recessions and downturns in the economy. Perhaps JPM would be a little bit more susceptible as it is a bank, but they always get bailed out anyway. So in that sense, they are defensive if you think of it in that perspective. And again, there's no clear-cut rule. It's just like when you're working out, there's not one way to stay in shape. The same idea. There's not one way to wealth and creating it and preserving. You could be much more overweight in these value names in JPM and Berkshire. You could add in Pepsi and those kind of names, or maybe you want to be a little bit more aggressive. You could add more Tesla and NVIDIA in these top names. They're the most aggressive in terms of growth, as they perhaps have the longest runway over the next decade, you could argue. Again, as always, everyone's situation is different. Their circumstances are different depending on their risk tolerance, their age, and what's going on with life. This is what's been working for me and for so many other people. Again, not one specific way to do things. It just depends on yourself, what works for you, having a plan, sticking to it for the long term. So that's how I would build a portfolio in 2021, 2022, and onward. Let me know in the comments below, do you agree or disagree with my philosophies? As always, like and subscribe, and I'll see you in tomorrow's video.